Welcome back to Ground Up Accounting. If you've been with me from the beginning, you'll know we've spent the last 3 episodes doing something that to an outsider may seem rather peculiar. We've built an entire business without selling a single cup of coffee. We've invested $50,000 of the owner's money into Ground Up Coffee. We've purchased an espresso machine. We've bought our first inventory or stock. We've learned the difference between buying with cash and buying on credit. We've received invoices from suppliers. We've built our chart of accounts from ground up and watched our balance sheet slowly come to life. In fact, if you looked at our books today, you'd say we own assets, we owe money to suppliers, and our accounting records are beautifully balanced. But there's just one tiny problem. We still don't have any customers. Now, that might sound like a slight inconvenience, but it's actually one of the most important moments in the life of any business. Because until somebody is willing to exchange their hard-earned money for something you've created, all you've really done is spend money in a highly organized fashion. Today, that changes. Ground Up Coffee opens its doors. For the first time, somebody walks in, looks at the menu, and says 5 words that every business owner loves to hear. Could I have a latte, please? To the customer, it's breakfast. To us, it's the beginning of the next chapter in our story. And to an accountant, well, it's several financial events happening at exactly the same moment. By the end of this episode, you'll understand why one simple cup of coffee creates multiple journal entries, affects both the balance sheet and the profit and loss account, changes our inventory or stock, creates a tax liability, and still manages to leave the accounting equation perfectly balanced. Now, that's the quiet elegance of double entry bookkeeping. It doesn't merely count money, it tells the story of a business. Let's keep things deliberately simple. Our first customer orders a single latte. The selling price before tax is $5. Now, we're using dollars throughout this series simply because they're recognized almost everywhere in the world. If you're watching from Ireland, the UK, Australia, Canada, or even the US, or anywhere else, just imagine these figures in your own currency. The accounting principles never change. We're also assuming a simple 10% sales tax throughout this series. Some countries call it VATs, others call it GST, or some others call it sales tax. Different names, same accounting idea. So, our customer pays coffee, it's latte, it's $5, and the sales tax at 10% of 50 cents. So that's a total payment of $5.50. Now the customer taps their card. The payment is approved. The money arrives in our bank account. Simple enough. Or is it? Here's where accounting begins to look at the world rather differently. Now, most people would say we've made $5.50. Not quite. We've received $5.50, but only $5 belongs to Ground Up Coffee. The other 50 cents belongs to the government. We're simply collecting it on their behalf. Think of it as holding someone else's, say, umbrella. You may be carrying it around, but it would be rather dishonest to start referring to it as your own. Now, the government has many admirable qualities. One of them is an uncanny ability to remember exactly how much of its money you're holding. So before we celebrate our first sale, let's record it properly. Whenever anything happens in a business, we ask the same question. Which accounts have changed? Now, our bank account has increased because money has arrived. Our coffee sales account has increased because we've earned revenue. Our sales tax payable account has increased because we now owe that tax to the government. Now, this gives us our first sales journal. So let's look at this. So under our accounts there, we have our bank, and it's increased by $5.50 on the debit side. Our coffee sales on the credit side has increased by $5, and the sales tax payable has increased by 50 cents. Just refer back to the that handy. If you look up here in the corner of the screen, just remember that very handy T account, which shows where revenue appears or income appears on our double entry accounts. Now, I just want you to notice something about this journal. It's one event, but 3 accounts, right? Now that's accounting. Not because accountants enjoy making life unnecessarily complicated, but because reality usually is a little more complicated than it first appears. Now, the journal captures the whole truth. Money's arrived, revenue was earned, tax was collected. 3 things happened simultaneously. Now, let me ask you a question. Where did the coffee come from? It certainly didn't appear by magic. That latte contained coffee beans, milk, a paper cup, a lid, perhaps a cardboard sleeve. Now, all of those items were sitting in our inventory account or stock account, waiting patiently for somebody to buy a coffee. Well, somebody finally has, which means our inventory or stock has fallen. And when inventory or stock falls because we've sold it, accounting moves that cost from the balance sheet onto the profit and loss account. This movement is called the cost of sales. Let's assume the ingredients used to make this latte cost us $1.80. Now, notice something rather interesting. The customer never knows this figure. They only see the selling price. But every successful business owner knows both numbers. Because without knowing what something costs to produce, it's impossible to know whether you're making money or simply keeping yourself busy. So let's record the second journal entry. So we have this new account on our chart of accounts created called the cost of sales, which we're going to find on our P&L. We are going to debit that $1.80. And now look at this, on our inventory or stock, we're going to credit that amount by $1.80, thereby reducing our stock and entry and inventory. So that is 1 coffee, 2 journal entries. Now, that's a wonderful example of why accounting is about understanding events, not simply recording payments. Now we can calculate one of the most important numbers in business. Revenue is coming in at $5, less the cost of sales at $1.80. Now this is going to equal our gross profit, something called our gross profit, at $3.20. Now don't make the mistake that catches so many new business owners out. Gross profit is not money you can spend. It hasn't paid the rent. It hasn't paid the electricity bill. It hasn't paid your insurance. It hasn't contributed towards wages. And it most certainly hasn't bought you a holiday. Gross profit simply tells us how much is left after paying for the goods we've sold. Everything else still has to be paid. Business has a curious habit of reminding us that there is always another bill just waiting around the corner. And that's why accountants are so interested in understanding the difference between revenue, gross profit, and net profit. They sound similar, but they're anything but. Now, just a note on the software. I just want to sort of point out, it doesn't matter what accounting software you're using. It really, really doesn't. What I'm teaching you is accounting. So, imagine somebody asked you, what's the best car to learn to drive in? You might say something like a Ford, or something like a Toyota or a Volkswagen. But the truth is, once you've learned to drive, you can sit in almost any car and work out where the steering wheel is. And now accounting software is exactly the same. So whether you're using QuickBooks, Sage, Xero, or any kind of bespoke double-entry bookkeeping system, they may all have different dashboards, and they may all have different buttons, but underneath, they're all asking exactly the same question. Which account do you want to debit? Which account do you want to credit? So I would encourage you to just watch what I'm doing throughout the series to learn double-entry bookkeeping properly. And if you do that, you'll never be tied to one particular software package. Now, this is why I enjoy teaching accounting through the story of Ground Up Coffee. We're not inventing journal entries because they're in a textbook. We're recording events because they happened. A customer walks through the door. The business earned revenue. Inventory or stock left the shelves. Tax was collected. Cash increased. Every account changed for a reason. And because every account has changed for a reason, every financial statement now tells a slightly richer story than it did yesterday. Accounting isn't simply recording history, it's explaining it. Now, let's prove that our books still balance. So let's have a look at Ground Up Coffee's trial balance thus far. As you can see, we've created some new accounts that will now start appearing. There's our coffee sales, there's owner's capital, sales tax payable, accounts payable, accumulated depreciation, depreciation expense. Look at that cost of sales. We now have on our chart of accounts, and we can see there that our inventory and stock account is included. But notice the debits and the credits, they all add together perfectly. 64,472.17 on the debit side, 64,472.17 on the credit side. So every debit equals every credit, exactly as it should. Notice that the trial balance doesn't tell us whether we've made a profit. It simply tells us every transaction has been recorded and is in balance. It's the accountant's equivalent of checking that all the pieces of a jigsaw puzzle are present before trying to admire the picture. So let's move on then to our profit and loss account. So here we have it. So far, we can see now that we've made some revenue. Our first coffee sale for $5. So total revenue of $5. Less the cost of sales we were looking at earlier of $1.80. So we have a gross profit of $3.20. So that's that end of our profit and loss. Then we have our what's called our operating expenses. And if you recall, the depreciation expense we recorded in our previous episode. So we are currently at a net loss of $163.47. Now, don't be alarmed. Many new businesses make a loss in their opening weeks or even months. We've bought equipment. We've invested in stock. But we've only sold 1 cup of coffee. Now, this isn't failure. It's simply the financial reality of a business that's only just opened its doors. So a good accountant reports reality. He doesn't attempt to improve it with wishful thinking. Now finally, let's look at the balance sheet. Now this remains my favorite financial statement because it answers one beautifully simple question. What does the business own and how has it been financed? So let's look at the Ground Up Coffee balance sheet to date. So under our assets, under our current assets, we now have bank at 50,005.5 cents. We can see there's been movement there in our inventory. It's down to 2,998.20. We can see the tax recoverable from the from our purchases, the tax that we paid over at 1,300. So we have total current assets totaling 54,303.70. Now let's look at our non-current assets. That would be our fixed assets. So we can see our coffee machine at $10,000, less the accumulated depreciation for the month. So the net coffee machine is coming in at $9,833.33. So our total assets, that's the current and fixed combined, is coming in at $64,137.03. Now let's look at the liabilities. So on our accounts payable, we owe our suppliers $14,300. We have a sales tax payable of 50 cents. So our total liabilities are coming in at $14,350. Now let's look at the equity or the capital account. So there is our owner's capital still at $50,000. But look at this here, the current year loss. If we look back at our profit and loss, it's coming in at 163.47. So our total equity is coming in at 49,836.53 cents. So our total liabilities and our total equity combined is coming in at 64,137.03. And once again, assets equal liabilities plus equity. Not because we forced them to, but because every single transaction we've recorded has respected the accounting equation we introduced back in episode 1. Now, that equation isn't merely a rule. It's the thread that quietly connects every chapter to this story. Today, Ground Up Coffee served its very first customer. The sale itself lasted perhaps 30 seconds. The accounting story it created will remain in our books forever. We've seen that one cup of coffee doesn't simply produce revenue. It consumes inventory. It creates tax obligations. It generates gross profit. It changes the balance sheet. It changes the profit and loss account. And it leaves behind a trail of journal entries that explain exactly what happened. That's what financial accounting does. It doesn't just record numbers. It records the life of a business. Next time, however, our story becomes a little more complicated. Not every customer pays immediately. Sooner or later, somebody asks for 30 days to pay. When that happens, we'll discover that making a sale and collecting money are two very different things. We'll introduce accounts receivable, explore customer credit, and learn why cash flow, not profit, is often the thing that keeps business owners awake at 3 o'clock in the morning. I'll see you in episode 5.